Darwinex Zero now supports trading in futures. For anyone who's only traded CFDs before, there are some key differences you need to be aware of. The main difference is that futures contracts have expiration dates, whereas CFDs don't. They're continuous. The expiration means that the contract stops trading on this date. One of the reasons futures expire is to act as a type of clearing mechanism, essentially removing market obligations and allowing for a fresh start in a new contract for that future. The expiration date is a non-negotiable deadline and therefore leads to some important considerations if you do plan to trade futures. Most of the considerations apply to trading futures in general, but there are also some that are very specific to trading them with Darwinex Zero. One of these is due to the fact that as expiration nears, there's usually a reduction in the liquidity of the contract and an associated increase in price volatility, all of which can significantly affect trading positions. To help ensure that any Darwins aren't overly affected by this behaviour, Darwinex Zero has the concept of a close date, which occurs slightly before the official expiry date. This can be thought of as an additional risk management feature aimed at protecting both traders and investors. So when trading futures with Darwinex Zero, it's this close date that effectively acts as the expiry of the contract. So let's now take a look at an example where you open a position during this first contract shown. What now happens if you want to retain this position beyond the close date? To do this, you'll need to do what's known as rolling over the contract. This effectively involves closing the existing contract and opening a new one with a later close date. This is made simpler by the fact that contracts overlap, usually by about 10 days, giving plenty of opportunity to do this. But as a Darwinex Zero customer, you'll know that we also have the concept of an index called a Darwin. This is a risk-adjusted version of the trader's signal account that participates in Darwinia and can also eventually attract third-party investor capital. So there are some additional considerations for how the Darwin handles future contract rollover, which I'll also explain in a moment. To understand the implications fully, it's first necessary to know what all of the key dates are surrounding a futures contract. So let's take a look at these 4 dates now. First, we have the trading available date. This is the first date that a futures contract can be traded, so represents the first opportunity to open a new position in that contract. Normally, this will be 10 days before the previous contract expires, which is what gives us the overlap period. At the opposite end of the contract timeline, we have what's called the close date, and this also includes the exact close time. Remember, this will be slightly before the official contract expiry time. And as we've already covered, this is a non-negotiable end date. So if a trader still has any open exposure at this time, it will be automatically closed by the platform. The next important date is termed the close only date. Before this date is reached, you're free to open and close positions in this contract as you choose. However, once this date is reached, it will then only be possible to close any existing positions that are already open, but you won't be allowed to open any new positions. This date is usually about 4 days before the close date. The last date of interest is what we call the Darwin rollover date. I mentioned before that each trader's signal account has an associated Darwin. If you manually close your exposure in your trading account before this date, then the related exposure in the Darwin will of course also be closed at the same time. However, if you have open exposure at the time this date is reached, then the Darwin will automatically close all of its exposure and simultaneously open the same exposure in the next expiration. To put it another way, the Darwin will automatically roll over. Why does this automated rollover occur? Well, as the close date nears, as we've already said, there's usually a reduction in liquidity and an associated increase in price volatility, all of which can significantly affect trading positions. And of course, therefore also affect the associated Darwins. So this can be thought of as a further risk management feature of Darwins aimed at protecting investors. It's seen as beneficial for the Darwin to operate in the most liquid version of the future. and the Darwin rollover date will usually occur a few hours after the contract moves into its close-only state. For complete clarity, let me walk you through a scenario that would occur if a trader decided to let their exposure in a contract get automatically closed by the platform at the close date, but didn't want to roll over and therefore didn't open a new position in the next contract. When this is the case, by the time the trader's exposure reaches the close date, the Darwin will have already rolled over into the next contract. So when the trader's exposure in the older contract gets closed, the Darwin's exposure in the new contract will also be closed at that same time. So despite the trader's signal account and the Darwin having exposure in different contracts by this time, Darwinex ensures the two remain linked as you would expect. Note that all of these dates for each contract will be published on our website, so you'll be able to properly plan. You can find these on darwinexzero.com by clicking on the Assets menu and then the Futures tab on the left. Here you can see the 4 key dates that we've talked about, and also note that you'll be able to see the current contract for each future, so in this example for soybeans, in addition to its next contract. To find out more about Darwinex Zero, visit darwinexzero.com and also see a link to our Darwinex Zero playlist on screen now, where you can find more videos explaining this unique offering.